Okay, I'm going to ask Lizanne to join me on the stage now. Guys, we're excited to have Lizanne Ubad from the Outsource CFO team here as well to guide us through this last session on the numbers. Lizanne, if you'll just jump on with me. There we go. Brilliant. So good to have you. Thank you for making time in your busy schedule. Guys, Lizanne has been with the Outsource CFO team for many of its years, for most of its years, as we've run the company. She's the senior most CFO consultant on the team. Lizanne has spent decades in the finance industry, and she really absolutely knows her stuff. Every single founder that she works with have only ever had brilliant things to say. Lizanne, thank you for being here with us today to share some of your wisdom. I'm excited to chat to you.
Thanks, Louw. Great to be here, and thanks for all those kind words. I appreciate it.
No, sincerely meant, and they're absolutely accurate. Cool, guys. So for the next 15 or so minutes, maybe a little bit more than 15, Lizanne and I are going to be talking about industry-leading growth, profitability, and cash flow. So from a finance perspective, we want to engineer maximum growth, but we also want to make sure that that growth translates into profitability, like Waze mentioned now, and that profit translates into good free cash flow within the organization. I think from Catherine's very first session at the beginning, it was mentioned that you can't just grow and scale without regarding profit and without regarding cash. It's not necessarily a sustainable business model, and I think Waze got all of us really excited about figuring out all of that. So Lizanne, I want to ask the first question here and just kind of lead with, we've spoken about growth. This is, scale up con. It's all about, building a company that can move fast and grow and get big. But we've also now spoken about profit first. So, which metric for you is really the most important one? Is it growth in terms of how fast are you growing, or is it profit? How much profit are you making as a profit percentage?
No, I think for me personally, both of them are really important. I think when you speak to different entrepreneurs, you'll get different answers. It sometimes depends on what's important to them and on egos, because sometimes we like the big revenue figures and sometimes we like the positive profit figures at the bottom and on the bottom line. I think both are important. I think you can't have one, well, you can have one without the other, but I think it's important to focus on your growth, because to have consistent growth on your revenue line, but not showing the profit isn't really sustainable for your business. But I think also over time, if you are profitable currently, you'll only be able to sustain that profit if you actually continue to grow, as long as you do it in a controlled environment. So yeah, I think definitely both are important.
Love it. Healthy, balanced approach. I can't that's really well put. So if we're talking about industry-leading growth and profitability and cash, I'm curious as to how you see those rates. Like, what is a good growth rate for a scale-up company? How would you define that? And what is a good net profit after tax kind of rate? Like, just for the audience to kind of get a feel for what are we talking about when we're speaking about industry-leading profitability, growth, and cash flow?
Yeah, I think it definitely depends on the industry. And I also think it depends on the size of the company. I think if there's, if you're maybe between 5 and 10 years in, showing revenue growth of about 20 or 30%, is a great metric. And I think if you're maybe younger than that, you may actually even see, depending on the industry, if it's high growth, you may see 40 or 30 to 40% growth year on year. I think on a net profit basis, I think one should always aim for a 10% net profit percentage. That's always healthy and, great to have. I think if it's more than 15 or 20%, then there's obviously a very good industry that you're in. I think it's Vern Harnish that says if it's more than 15%, you should take your profits and run, because at some stage, the competitors will figure out what you're doing. But it really depends also on what you feel comfortable with, how you want to run your company. Do you run it as a lifestyle company, or do you have external shareholders? So it all depends on the industry and what's important for you as well.
Thanks, Lizanne. That's a good thing to just kind of put a number in the sand in terms of profit percentage, what to work towards. I think it's also Vern who says if a company is doing under 5% net profit after tax, and they're probably on life support. So always mention that 1% profitability, and 1% is in the green. Mark Cuban might give you the thumbs up after 90 days. But we want to try to actually get to at least 5%. Below that, it's unlikely that that profit will translate into cash flow, because there's a lot of other elements outside of the income statement that also suck cash. And Lizanne and I are going to kind of get into this a little bit just now. So we want to get the profit to at least 5% or more, 10% being a great benchmark. I love that. So Lizanne, I want to chat about this tool we often use around finance called the Power of One and the 7 levers. It's part of the scale-up methodology. If you guys have spent some time in the book by Vern, it's a really good tool to have a look at. You can find some good templates on it. But it basically argues that there's 7 levers that a founder or a management team can pull to increase profitability and cash flow within the organization. And the first 4 levers really influence both profit and cash, and the last 3 only cash flow. So it's basically around kind of increasing revenue, decreasing costs, or making your working capital cycles shorter. So Lizanne, can we just stand still on these kind of 7 levers, and the concept that if you can improve each one of them by just 1% over every period, like every quarter or so, you just improve them with 1%, it'll have an astronomical result at the end of the day in terms of how much free cash flow the company generates and how much profit they actually make. The first metric is obviously start at the top, kind of grow the top line, right? So there are 2 ways to do that. And the first one is basically to sell more, right? So to sell more of what you're currently offering in the market. Would you be able to talk to the tactics and tools that you see kind of being deployed to make sure that you increase your top line revenue by selling more to your core customer?
Yeah, I think you can obviously either sell more of your existing product or services, or you can expand your services that you have. So, if we firstly focus on sell more of your existing products, is to make sure that your existing clients are happy with the value that they receive and the quality of the product, because we should never underestimate that the value of word of mouth and what that can mean for your business. Obviously, marketing has a great impact on that as well, to increase your volumes. And I think when it comes to selling different products or on volumes, it's a great thing to look at your value chain that you're currently working on. So is there maybe something small that you can add to your product or to your value that you're currently giving, that a client is potentially getting elsewhere at the moment? So, something small like, can you personally deliver a product instead of getting a third party to deliver that? So that's definitely something to look at your value chain. And it's great to have a strategy session on that, because I think many times entrepreneurs focus on the one service that they are providing at the moment, and they don't really always, it's difficult to see the bigger picture. But I know, speaking of Profit First that you guys mentioned earlier, I know the Profit First book says focus on what you're really good at. So it's also about finding that balance. So I think that's on volumes, and then on selling price, obviously also focusing on what your client really needs, where they find value. I think if your clients find value in your product and in your service, then if you're going to make a 1% difference or increase on your price, they're not actually going to feel it. They're going to pay it with a smile if they're happy with your service and your product from in the first place.
Brilliant, yeah. And I mean, because revenue is such a biggie, it's the biggest number on the income statement. Like if you're running at a 10% profit margin as an example, then that 1% increase in price could translate to a 10% difference in bottom line, which is massive, right? Then you for Mark Cuban, you move from your 1% to 11% by putting up your prices with 1%. That's really quite exciting. And once you start doing those numbers with the power of one, I think it really becomes apparent, like, wow, small incremental moves on price increases, continuously selling more and managing costs, really translating to exciting results for the bottom line. So then I guess if we're talking about it, so it's great to think about like increasing volume or increasing price to move revenue up. And there's a lot one can do in the way of that. but also, but what's even more in your control is your cost base, right? Like how much you actually spend, firstly directly and secondly indirectly. So let's talk about your cost of sales or your cost of services, your direct costs that are related to your core business. Lizanne, how can one think about managing that downwards?
Yeah, so I think what's important to remember there, firstly as well, Louw, is to make sure that whatever cost you are cutting is not compromising the service or the product that you deliver to the client. So that you still keep that at the same level. But it's always a good idea to have conversations with your suppliers to see if there's any discounts that you can negotiate, if there's any economies of scale that you can apply to have cost savings on that. And also for internal efficiencies on direct cost, if you may be in a service industry with staff and applying resources to that. I think that's on your direct cost. On your overheads in general, I'm a big fan of starting from scratch and really going through your expenses in a lot of detail. I think that, whenever I go through that process with a client, they always realize that there are subscriptions that they actually don't need anymore, or they're paying for Office 365 subs for staff that left a long time ago. So it takes time. It's painful. Many times you think, the odd 100 Rand here and there won't make a difference, but it all adds up. So definitely, I think it's definitely worthwhile spending that time and going through the expenses in detail and see what you can cut on, and also what's necessary, because as you say, those are the things that are within your control. That's easy to cut down.
Right, I love that. It makes me think of Marie Kondo. I'm not sure who has seen Marie Kondo clean a flat or a house. But what she does, she takes like all the clothes out of the cupboards, pile them onto the floor, and only the ones that spark joy get to go back into the cupboard. I think that's a really nice approach to do with your operational expenses, to like throw everything out, like Lizanne said now, and then from that whole big pile in the middle of the room, you choose which ones spark joy, which ones actually really contribute to the operations of the company, and only those ones do you allow back. And it's a lot. I think you'll get a lot more done in terms of the actual result than if you were to just go through everything top to bottom and think, do we need this? Yes, no. Do we need this? Yes, no. It's not quite the same. So you don't necessarily have to be as brutal necessarily as when COVID hit, like Wace mentioned earlier. But so it really helps to go through with a fine-tooth comb, like once a quarter, once a month, just literally look at the detail of your expenses and what you're actually letting flow out of the company. So Lizanne, thank you very much. If we're gonna, there's two different tactics to increase revenue, two different tactics to decrease cost, and that both applying those four levers will get you to a better profit at the end of the day. If we don't listen to Oasis, the revenue minus profit is expenses. If we take the old school accounting methodology of revenue minus expenses is profit, then that'll get us to a bigger bottom line by increasing our revenue and decreasing our cost, which is already an exciting metric. But then profitability is always going to be vanity if you're not able to translate that to cash. So the last three levers are all around generating free cash flow, and there's a couple of things you can do without moving your profit that can actually increase the amount of operational cash in the company. And those things are all around managing your debtors, creditors, and inventory. Lizanne, maybe can we first just chat about the debtors cycle, all the way from invoicing to recovering the cost from your clients? Like, how can one go about optimizing that? Because I guess the faster the cycle and the pulse can be from when you get a client to when the money's in the bank. If that's very short, that's quite exciting. If it's very, very long, it's quite difficult. You need a lot of cash to manage a very long revenue cycle. So how can one speed up the debtors process?
Yeah, I think there are so many different things that one can do. If you're in a service industry, it's definitely one of the things to look at is work with your clients on a retainer basis, like we do, for instance, at Outsource CFO, and get your invoices out as soon as possible. Try to get the majority or all of your clients on debit orders so that you don't rely on them making payment, but you can actually collect at a certain point during the month. I think there shouldn't really be any delays between, when a client has indicated that they want to go ahead with a service or buy a product and actually invoicing that client. you'd really need to work on that while it's hot, to get that out. And then definitely, following up on if you do reach a point of long outstanding debtors. I think maybe before that, there's the accounting systems and the cloud accounting systems that we have currently available to us are so great at sending automatic reminders to clients and so sending out automatic statements. So use all of those things to your advantage to make sure that you get your money in as soon as possible. I think if you do then get into a place where debtors have not paid, definitely to act on that as soon as possible. I had a conversation with insurers recently that basically insures your credit book. And they're saying definitely that, they can see the longer that you wait to collect, the more difficult it is. So if you think, oh, you'll phone them next week or, the week after, even those days can make a big difference. And I've, for instance, in one of my clients, the owner and main shareholder of the company is the person who follows up debtors. So she doesn't leave it to the accountants, but it has great results. So she has, very, very few long outstanding debtors, but she makes the time to phone people. And she said even just them getting an email from her inbox instead of an accounts at or whatever makes a big difference. So I think it's great to implement that personal touch there as well.
Absolutely. Yeah, I think what regardless of what kind of business model you run, I think deploying the right tactics to make sure this cycle is as quick as possible. If you need to make sure that you're the person at the front of the line to get paid, and that the payments are coming in timeously from the clients. And the shorter you can make that cycle, regardless of whether it's products or services, the quicker cash flow comes into the company, and the quicker you can expand operations without taking capital, which is always quite exciting. Because on our last two levers are around kind of like slowing down creditors days and also around inventory days. Like how can we slow down creditors and move inventory faster? Maybe just talk to us about those two a little bit, please.
Sure. So on your creditors or your suppliers, I find definitely the best approach there is to have a personal relationship with your suppliers and to keep communications open. And once again, to apply economies of scale, and through building that relationship, you can maybe negotiate longer payment terms. Unofficially, if you have 30 days, push it to 31 or 35. That doesn't necessarily help with the relationship, but rather keep the communications open. That's obviously a last resort to do that on your creditors. And I think with the inventory days, it all comes down to planning. It comes down to knowing your customer behavior when you need your stock. Definitely use the information that you have available to turn that into intelligence and act upon that to make sure that you don't sit with a warehouse full of stock and that you can move that quickly. So it's really about finding that balance in that process as well.
Thanks, Lizanne. Yeah, there are some really amazing cloud inventory systems nowadays that you can amazing detail around inventory days of individual stock items and profit margin per unit of stock. It's really, really cool. If you're already running on a cloud system like Xero for your accounting, having an inventory system like an Unleashed inventory or something like that implemented and linked to that is really incredible. Like the information and the data that comes from that for management to make decisions with this is super exciting. Thanks, Lizanne. I mean, that Power of One and 7 levers tool is really a favorite on this, and I think there's so much locked up in it for founder teams who want to grow profit and cash. So keep that in mind when you're striving to improve those two core metrics. Lizanne, I just want to get into, like, I think doing the numbers, like running the finance, has a lot to do with the detail, right? So I want to hear kind of like, what are the details, like the key questions and the details that founders need to ask of their finance teams if they want to dig into like an increase in profit or increasing in cash? Like what are those things that are almost like profit per X unit that you would generally identify?
Yeah, I think some of the most valuable information that you can get from your finance team is to get really granular on your profit per X, as you mentioned. Whether that's profit per client profit per type of client, profit per location, or profit per product. All that information that you can get, again, if you can turn that into intelligence, which can help you to make better decisions, you can improve your business on various levels. I recently had a situation with a client where they got a specific or a special sales consultant involved in their business, who asked for a lot of details on their sales, and they did analysis actually for the client, where they calculated that 28% of their profit is coming from 94% of their clients. So, you know, they've got a lot of it, but that's based on number of clients. So they have a large number of clients actually not contributing to a very big part of their revenue. And in the same instance, they did calculations, and they realized that their revenue per customer is actually very low, and their gross profit per customer is actually very low. And in that process, they realized that that's actually not the type of customers that they want to continue with. It's not the type of customers that will allow them to scale their company. They don't have the time and energy to service all those customers. So if they do want to continue with them, they'll definitely need to bring in a lot more automation. You know, and that's the thing where if you do, you know, all your spreadsheets and calculations, where things can get really exciting, because now the directors can go away and they can make decisions based on that. Yeah, so
those light bulb moments, right? When the founders are like,
yes, exactly.
Wow, like it's you know, the numbers have always been there, but now it makes sense, and now there's an actionable insight. I love that.
Yeah, exactly. Yeah.
Brilliant. There's also one of our big topics was on people, right? And people are generally the biggest expense on most companies' income statements, whether it's product or services companies. Generally, people are a big part of the operational cost. So I just want to talk while we have the last few minutes, just around like, how do you maximize with client-facing or production-focused staff in a growth firm?
So I think there's a great ratio for all companies to do is something called a labor efficiency ratio. Labor obviously reminds us more of manufacturing. So in service industry, you can use a staff efficiency ratio if you like. And what you basically do is you take your gross profit and you divide it by your total staff cost. So you say for every R1 that I spend on staff, how much gross profit or revenue are they bringing in? And you know, I had an experience a few years ago when I did this exact calculation for a client, and they said, of everything you've showed me, this is the most valuable ratio I've seen. You know, it's great to see clients having that aha moment, but also in their industry where they were in marketing and they had a lot of staff that was very valuable to them. So in service industry specifically, that ratio is usually between 2.5 and 3, but it depends on your industry. So you need to determine what is ideal for your industry, or also what you feel is palatable for your company. And then obviously to again use, sorry, I sound like a broken record, but to use the information and turn it into intelligence to make good decisions on. So the things that you can, for instance, look at there is you can look at your people. So, you know, if you have a very low ratio, what it will show you is that you probably need more skilled people, or you need to work on your talent of your people. You need to look at execution and the processes that you have in place. Or is it actually not your people in the execution? Is it actually on your strategy and the type of clients that you have in place? So, you know, I think there are various ways that you can those three things: people, strategy, and execution, and what you need to tune to improve that.
Lizanne, that's an amazing summary. I love that. I would still love to ask you about cash flow forecasting, and I'd love to still speak about fundraising for a growth firm. But luckily, we had fundraise con fairly recently, so I hope all of you guys had a look at that. If you haven't, I think it's on our YouTube channel, so you're welcome to have a look at that. There's a whole conference on cash flow and fundraising. Lizanne, just for the sake of time, I'm going to wrap us, but thank you so much for sharing your insights. I think that was crisp and concise. Really appreciate it. And thank you for everything you do at CFO.
You're welcome. Thanks, Louw.
Hey, Louw here, one of the founders of Outsource CFO. If you enjoyed this video, make it official. Click subscribe.